If you leave a pile of cash in a drawer, you aren't just saving it, you're slowly setting it on fire. It sounds dramatic, but in a world where the cost of living climbs, while the value of a stagnant dollar falls, doing nothing is the riskiest move of all. We are here to talk about how the global economy forces smart money to move, why trading cards have become one of the vessels for that movement, and how you can apply macro finance principles to build a portfolio that doesn't just survive, but thrives. The silent killer, inflation versus growth. We have to zoom out to understand the battlefield. Due to inflation that seems to have exploded in the last few years, there has been a massive cultural shift in how people view their capital. For example, a standard savings account rewarding you with 1% a year is actually a losing bet when the US inflation rate is hovering near 3% as of early 2026. You are effectively paying the bank 2% of your purchasing power just to hold your money. For those looking to grow their monetary value, the game is simply finding stores of value that outpace that decay. That could be real estate, stocks, tangible assets, collectibles, crypto, or yes, trading cards. The overall goal is to multiply your value by putting it into assets that are growing, because if they aren't growing, they are obviously dwindling. There is no middle ground where value stays perfectly static. It is always drifting up or down. This reality makes it vital to remain vigilant to current markets. While the S&P 500 or retirement accounts are foundational tools, they often move too slowly for those looking to aggressively build wealth in a shorter window. You need to identify vehicles that capture it. It sounds simple. Just put money where it grows. But current market conditions are anything but simple. With the recent crypto decline and the global conversation around de-dollarization, relying on a single asset class is dangerous. Real money movers know they must pivot and diversify into different eggs in their basket. This necessity to diversify is exactly what leads savvy investors toward alternative assets like collectibles, specifically TCGs, where we see a consistent, predictable churn of value that other markets rarely offer. This brings us to the collectibles egg, where the mechanics of TCGs mimic a stock market. The pattern for Pokemon, for instance, is a masterclass in market cycles. They set a series release like Sword and Shield, release several sets within it, Evolving Skies, Lost Origin, Crown Zenith, and then move to the next era, Scarlet and Violet, Stellar Crown, Surging Sparks. Now, in 2026, we are deep into the Mega Evolution series. As new sets release, the old ones rotate out of print. This natural expiration date creates a scarcity vacuum that drives supply down and demand up, a near-perfect formula for buying low and selling high. While no return is guaranteed, history has shown this pattern to be reliable for years, which is why we treat Pokemon as the gold standard of TCG investing. Most seasoned collectors roll their profits over. They sell the appreciated, out-of-print sets and reinvest into the current active series, like the newly released ones. It creates a compounding effect. You aren't just holding a card, you are holding a share in a mechanic that has proven resilient against broader economic downturns. Not everyone plays for the long-term hold, though. Some resellers make their best money by keeping a constant churn and operating on smaller margins. They may not make the most profit per individual box, but because of the high volume and constant sales, they keep money flowing freely and spiraling upward without the risk of being stuck with stagnant product. Sealed booster boxes have created a verifiable store of value, attracting investors with money burning a hole in their pocket who want to park cash in physical assets rather than digital numbers. Will this trend continue? We think so, though this is speculative and just our opinion. The bullish case for TCGs relies on non-financial factors: popularity, media integration, and IP strength. Pokemon's simultaneous anime and video game releases coincide with their TCG expansions, creating a feedback loop of hype. Similarly, One Piece boasts incredible strength via the Netflix live-action series, the manga, and fresh anime content. These aren't just games, they are cultural monoliths. This engagement spills over, boosting other TCGs we've discussed like Gundam and Dragon Ball. Even Magic. The Gathering has seen success with its Universes Beyond collaboration, though the Final Fantasy set from last year is still proving which cards are the true hits and misses. The economic reality check. However, we must be realistic. The economics of 2026 are harsh. If you are struggling just to make ends meet, this is not the time to throw cash into cardboard. It is a luxury market. But for those with excess income, it is one of the best times to find financial opportunities outside of a 9 to 5. The goal is to ensure your savings are growing, not just inflating. Be smart. Look for stores of value that help you diversify, exercise strict risk management, and most importantly, remain analytical in your pursuit of growth. Some of the best advice I've received is to not overestimate what you can do in one day, but don't underestimate what you can achieve in 1 year. When dealing with finances, it takes a long-term mindset to see assets appreciate. Don't get caught chasing the anomalies of TCG booms that promise 2 times or 3 times returns in weeks. Real wealth is built by identifying low-risk entry points, holding a long-term outlook, and keeping your portfolio leveled by selling when appreciation hits your goals. Our goal at TC Journal is to provide guidance navigating this ever-changing TCG market. To join, visit tcjplqyer.com for our free daily newsletter or upgrade to our weekly undervalued picks.